Investing is a journey that many embark on, often starting from a young age, and my own experience began when I was just 11 years old. At that time, I was curious about how money worked and how it could grow over time. I remember the excitement of buying my first shares, feeling a mix of thrill and apprehension as I navigated the complexities of the stock market. Over the years, I've learned invaluable lessons, not just about the mechanics of investing, but also about patience, discipline, and the importance of research. This video aims to share my personal experiences while also providing educational insights into the principles of the stock market. Understanding these principles is crucial for anyone looking to invest wisely. The stock market can seem daunting, but with the right knowledge, it becomes a powerful tool for building wealth. I'll reflect on my early mistakes and successes, emphasizing that every investor has a unique path shaped by their decisions and experiences. It's essential to grasp concepts like diversification, risk management, and market trends, as these will guide you in making informed choices. Investing is not just about numbers. It's about understanding the broader economic landscape and how various factors influence market movements. As we delve into this topic, I encourage you to think critically about your own investment strategies and the lessons you can learn from both triumphs and setbacks. By sharing my journey, I hope to inspire you to take control of your financial future and approach investing with confidence and knowledge. Together, we'll explore the intricacies of the stock market, aiming to equip you with the tools necessary for successful investing. Let's embark on this educational and reflective journey into the world of investing. My initial foray into investing was marked by a blend of excitement and uncertainty as I began experimenting with stock timing and charting. At first, I approached the market with a sense of trial and error, often buying and selling based on gut feelings rather than a solid strategy. I vividly remember poring over stock charts, trying to decipher patterns and trends, but without a clear framework, my efforts often felt like shooting in the dark. This lack of structure led to a series of ups and downs, teaching me that investing is not merely about making quick trades, but requires a deeper understanding of market dynamics. During this time, I realized the importance of seeking knowledge to refine my approach. I turned to the local library, where I discovered a treasure trove of investment books that would profoundly influence my journey. Authors like Benjamin Graham and Peter Lynch became my mentors, guiding me through the principles of value investing and the significance of thorough research. Their insights helped me shift my perspective from impulsive trading to a more analytical approach, emphasizing the need for patience and long-term thinking. As I absorbed these lessons, I began to appreciate the importance of having a well-defined strategy and the role of fundamental analysis in making informed decisions. This period of exploration was crucial, as it laid the groundwork for my future endeavors in the stock market. I learned that investing is not just about timing the market, but understanding the underlying factors that drive stock prices. Each mistake became a stepping stone toward greater knowledge, reinforcing the idea that continuous learning is essential in the ever-evolving world of investing. Ultimately, my early experiences taught me that a thoughtful approach, grounded in research and education, is key to navigating the complexities of the stock market successfully. Benjamin Graham's book profoundly shaped my investment philosophy, introducing key concepts that transformed the way I view the stock market. One of the most significant lessons I learned from is the importance of viewing stocks not merely as ticker symbols, but as actual parts of businesses. This perspective shifted my focus from short-term price fluctuations to the underlying value and potential of the companies I was investing in. By understanding that each stock represents a share in a business, I began to appreciate the importance of analyzing a company's fundamentals, including its earnings, assets, and overall financial health, emphasizing the necessity of understanding a company's economic characteristics and management. He taught me that a company's competitive position within its industry, its growth potential, and the quality of its leadership are critical factors that can influence its long-term success. This understanding helped me develop a more comprehensive approach to evaluating investments, allowing me to make informed decisions based on a company's ability to generate sustainable profits over time. Moreover, Graham's foundational principles of investing, such as the concept of margin of safety, became cornerstones of my investment strategy. He advocated for buying stocks at prices significantly below their intrinsic value, providing a cushion against potential losses. This principle instilled in me a sense of discipline and caution, reminding me that investing is not just about chasing returns, but also about protecting my capital. Incorporating these key concepts from Graham's teachings into my investment philosophy has been invaluable. They have guided me in making thoughtful, long-term investment decisions while fostering a deeper understanding of the market. By focusing on the intrinsic value of businesses and the factors that drive their success, I have been able to navigate the complexities of investing with greater confidence and clarity. The concept of Mr. Market, introduced by Benjamin Graham, serves as a powerful metaphor for understanding the stock market's unpredictable nature. Mr. Market is depicted as an emotional partner in investing, one who offers to buy or sell shares at varying prices every day based on his mood. Some days, he is exuberant, offering high prices for stocks, while on other days, he is despondent, presenting low prices that may not reflect the true value of the underlying businesses. This volatility highlights the inherent unpredictability of the market, reminding investors that stock prices can fluctuate wildly due to emotions rather than fundamentals. Emotions play a significant role in how investors make decisions, often leading to irrational behavior. When Mr. Market is in a panic, many investors may succumb to fear, selling their stocks at a loss, while during periods of euphoria, they might chase after rising prices driven by greed. This emotional roller coaster can cloud judgment and lead to poor investment choices. Understanding Mr. Market's temperament allows investors to detach their emotions from their decisions, fostering a more rational approach to investing. The key takeaway from the concept of Mr. Market is the importance of taking advantage of market conditions rather than being swayed by them. Savvy investors recognize that when Mr. Market is overly pessimistic, it can present opportunities to buy undervalued stocks at bargain prices. Conversely, when he is overly optimistic, it may be wise to consider selling or trimming positions. By maintaining a disciplined approach and focusing on the intrinsic value of investments, investors can capitalize on the market's fluctuations rather than becoming victims of them. Ultimately, understanding Mr. Market empowers investors to navigate the emotional landscape of investing, enabling them to make informed decisions that align with their long-term financial goals. Valuing businesses rather than fixating solely on stock prices is a fundamental principle that can significantly enhance investment success. The need to assess a company's long-term value is paramount, as it provides a clearer picture of its potential for growth and profitability. While stock prices may fluctuate daily due to market sentiment or external factors, the intrinsic value of a business is rooted in its fundamentals, such as earnings, cash flow, and overall financial health. By focusing on these long-term metrics, investors can make more informed decisions that align with their financial goals. Understanding a business's competitive advantage is another critical aspect of this valuation process. A company that possesses a strong competitive edge, whether through unique products, brand loyalty, or operational efficiencies, has a greater likelihood of sustaining profitability over time. By identifying and analyzing these advantages, investors can better gauge a company's resilience in the face of market challenges and its ability to generate consistent returns. This deeper understanding allows investors to differentiate between companies that are merely riding market trends and those with solid foundations poised for long-term success. Moreover, separating price from value is essential in making sound investment decisions. Stock prices can be influenced by a myriad of factors, including market speculation, economic conditions, and investor sentiment, which may not accurately reflect a company's true worth. By focusing on the intrinsic value of a business, investors can identify opportunities where the market has mispriced a stock, allowing them to buy undervalued assets or sell overvalued ones. This disciplined approach fosters a mindset that prioritizes long-term growth over short-term gains, ultimately leading to more sustainable investment outcomes. In essence, valuing businesses rather than merely tracking stock prices empowers investors to make decisions based on solid fundamentals, enhancing their chances of achieving lasting financial success. The concept of margin of safety is a cornerstone of prudent investing, emphasizing the importance of having a buffer when making investment decisions. At its core, the margin of safety refers to the difference between a stock's intrinsic value and its market price. By purchasing stocks at a price significantly below their calculated intrinsic value, Investors create a cushion that can protect them from unforeseen market fluctuations or errors in their analysis. This buffer is crucial because it allows investors to mitigate risks and safeguard their capital, especially in an unpredictable market environment. Assessing the risks associated with investments is an essential part of establishing a margin of safety. Investors must consider various factors, including market volatility, economic conditions, and the specific risks tied to the companies they are evaluating. This involves conducting thorough research and analysis to understand a company's financial health, competitive position, and potential challenges it may face. By identifying these risks, investors can make more informed decisions about how much of a margin of safety they need to incorporate into their investment strategy. Cautious decision-making in stock purchases is vital to successfully implementing the margin of safety principle. Rather than succumbing to the temptation of chasing high-flying stocks or following market trends, investors should focus on acquiring shares of fundamentally sound companies at attractive prices. This disciplined approach encourages patience and a long-term perspective, allowing investors to wait for the right opportunities rather than rushing into potentially risky investments. Please consider subscribing to our channel for more insights and strategies on investing. Don't forget to like this video and share it with friends or fellow investors who might benefit from these discussions. Your engagement helps us create more content that empowers you on your financial journey. Thank you for joining us, and we look forward to seeing you in our next video.